Alright, in this video we are going to make an update on the gold forecaster index, and this index uses a lot of leading indicators to predict the gold price. So let's start with it. So this is the gold forecaster index, the red line here, and whenever it goes below 0, it means that the gold price will be going down. And the latest number can be found here. You see there's a little blip upwards, but it's still in negative territory. So I believe that the gold price will not be doing well in the coming months. And this index is based upon several indicators like the capacity utilization, the 10-year yield, trade balance, and the money stock MZM, and the producer price index. So let's go over all of them. Let's start with the money supply. So as you know, the Federal Reserve has been decreasing the money supply by selling bonds and mortgages. So you see the red line is going down, and this will in time it will also pull down the broader money supply indices. Like the green one is already flattening out. So this is not positive for the gold market. Let's go to the capacity utilization. So here we can see that the capacity utilization is going up to the 80% level. That's very positive for inflation, because Trump is now pulling all production back to America, which means that this index will probably keep going up. So everything will be produced in America. And whenever that goes up to the 80% level, usually the inflation will also go up. So that's a positive for gold. Let's go over to the next one. Which is the producer price index. Now the latest number for the producer price index, which is the leading indicator for consumer price index, is telling us that it's going down a bit, but it's still positive, which means that the consumer price index will probably keep going up. We should really monitor this blue line. If it goes back to 0, then we have a problem. So this is still positive. Let's go to the 10-year yield. And here in the 10-year yield, we can see that it is, well, this is the index of the 10-year yield minus the consumer price index. So whenever this goes down, the gold price goes up, because you want to have a low yield, because gold is not an interest-bearing asset, and then you would go to gold when this goes down. And minus means that when the consumer price index goes up, then the blue line will go down, which means there's inflation, and gold does well during inflationary times. So whenever this goes down, the gold price will go up. And when you look at the latest numbers here, it seems that this line is moving upwards. So that's really not a very good indicator that gold will be going up. It will probably go down. Yeah, but we were still in this trend here. So there was a little bit of support for gold going up, but now it seems that that will be subsiding. And let's go over to the last indicator, which is the trade deficit. The latest trade deficit numbers from October were, well, pretty good for gold, because you can see this small blip here going down, which means the trade deficit has been going up. So whenever the trade deficit goes up, which means this chart goes down, then the gold price will be doing well, because that's bad for the US dollar. So we have a mixed set of indicators now. Some are good, some are less good, or even negative, and that tells us that we have more negative than positive indicators. So this chart, the gold forecaster index chart, tells us that it's more likely that the gold price will be going down. So at this moment I would say that investors should put their money in cash instead of gold and wait it off. Wait till this chart goes back in positive territory. Okay, see you in the next video.